Hello, welcome to Venture Capital with me, Katie Pilbeam. This week, talks recommenced on the transatlantic trade deal. We analyse the risks, though, that could pose the average consumer. That's coming up in just a minute. We've also got the Eurozone. It could be embracing negative interest rates. What exactly does this mean? As well as that, we're going to be talking diamonds, paintings, metals, bitcoins, and my sidekick, Mr. Sean Thomas. He'll be up later on, so lots to get through, but first. The US-EU trade deal is worth an estimated $150 billion for both parties, but these huge profits could come at a cost to the average consumer, and there are plenty of stumbling blocks holding up the deal. So let's go through what each side wants then. So the US is asking for EU restrictions on genetically modified crops and chlorine-washed poultry to be cut to maintain intellectual secrecy and for more access for US service providers. The EU wants the beef ban, which was first introduced because of the mad cow disease, to be lifted, a reduction of tariffs on items such as cheese, and the free flow of information. So now let's dive deeper into the consequences of the deal with Rodney Shakespeare. He's a professor of economics. He's based in London today. This deal will involve limiting health and environmental regulations to boost growth. The question is, how will this affect the average consumer then?
It will not limit health and environmental considerations. It will wreck them. This agreement is roughly half of the world trade, and it's connected with the Trans-Pacific Partnership. So whatever is in this is going round a large part of the world economy. It sets up secret tribunals in which there will be no defence and there will be no openness, and in which the big corporations can do what they like. And an example at the moment is in Ecuador, where Chevron is pouring billions of poisons into the Amazonian ecosystem, which I think is perhaps the largest in the world, and no one would be able to do anything about it. So you can forget health and environment. It's all going out of the window in order to serve the interests of a small group, largely of American corporations.
So are you saying that the average consumer will be exposed to harmful chemicals then? Is that what we're talking about here?
There will be no way of stopping that exposure. In the tribunals, there is the doctrine of expected profits. And I, as a corporation, can pick any figure out of the sky and then say that you, as an individual, or you, as a government, are stopping my expected profits. Therefore, anything that I do which is harmful will not be able to be stopped, and indeed anything you do to try to stop it will result in you as individuals being fined or jailed, and as a government unlimited fines, all of which ultimately will go back on your population.
So if these big corporations can take on governments, does that mean that a country would be at risk of losing its sovereignty?
Not at risk. They will actually lose it, full stop. You see, the power, the real power, is the economic and financial power. And these corporations include the global banks and the big companies. And that power will have shifted into tribunals who are only serving the interests of those global banks and companies. National sovereignty will effectively no longer have any meaning, and we will have gone under essentially a global fascist system. And it's now happening so very, very fast. I mean, people have got to wake up about this. This system is setting in a financial control, putting everybody into debt, increasing rich-poor division, exporting jobs, you name it, it is happening. And rather like the frog being boiled so it doesn't realize it's being killed, that is going on. And this agreement and the associated agreement for the Pacific will put the whole world under the control of the big corporations. OK,
we'll leave it there, Mr. Shakespeare. Thank you ever so much for your perspective on the matter. And the biggest trade deal in history could get even bigger. if Ukraine were to join. Kiev is set to sign a free trade agreement with the EU at the end of the month, providing it has met a strict set of conditions, which include electoral reform and improving infrastructure. But this move west has resulted in a tug-of-war with Russia. President Putin wants Ukraine to join the Russia-led customs union instead, and warns of economic disaster for Kiev if the European deal is sealed. We're going to have full analysis of the outcome of the EU's decision in next week's show, so be sure to join me for that one. The Eurozone has been dealt a plethora of disappointing data recently. The biggest economy in the zone, Germany, grew just 0.3% in the last quarter, and France and Italy, the bloc's next biggest economies, both suffered small contractions. So with stagnation and joblessness posing huge problems to the region, the European Central Bank is now considering introducing a negative interest rate to stimulate growth. Is this the answer? Well, let's ask Brenda Kelly from IG Markets. Brenda, can you tell me what risks would they pose to the Eurozone?
I would think negative interest rates are something that could be considered by the ECB. It might be in an effort to spur inflation, and obviously we are seeing disinflation in the Eurozone as a whole. What it could actually mean, though, is that we'll see some negativity on bank profits, because if you reduce the deposit rate, which is currently at zero, for the banks to place their money with the ECB, it will obviously impact their profitability, and that as a whole might not necessarily be good for the Eurozone in the medium term. Nevertheless, you also have the conservative wing of the ECB who fear that negative interest rates could spur proper inflation, like hyperinflation, and that is something that has been tried to be avoided in terms of price stability over the last number of years.
What about bubbles, Brenda? Should we be worried about bubbles?
I think we definitely should be worried about bubbles. I think if you look at the Janet Yellen testimony, where she categorically stated that asset prices were not in a bubble, particularly the equity market, and then the equity market continued to push to record highs in the US, I think it pretty much negates any feeling that what has been happening with liquidity and cheap money over the last number of years has been anything to do with underlying fundamentals. And if you look at perhaps, say, the mining sector vis-a-vis the indices themselves, there is a massive divergence, and the demand for commodities such as base metals like copper have been at a huge low recently. So this in fact proves that the growth is not there to support what is happening in the stock markets, and one will have to meet the other, and I fear it may be the stock market that makes a return to the downside rather than the other way around.
Brenda, that's really interesting, because it seems like there's a real disparity between the stock markets and the real economy. We've got historical highs on the markets and yet historical unemployment rates. It just doesn't make sense, does it, at the moment?
It really doesn't. If you compare the US indices to the European counterparts, there is certainly a degree of underperformance over here in Europe. And obviously this is coming down to the fact that we've seen lesser growth. We've also seen a pullback in momentum with the likes of Germany just over the last week. And then, of course, we saw France entering contraction there in the last quarter. So we might have seen Spain pull out to an extent out of a long-term recession by 0.1% growth in the last quarter. I don't think the Eurozone is any way able to say that the crisis has been fixed, and if anything, I think that the actual demands that there are within the Eurozone are very apparent, and this came, I suppose, from the ECB cutting rates just very recently. And the fact is, we could actually see some more interest rate cuts over the coming quarters if growth doesn't get back to where it should be, and of course, as long as inflation remains below that key 2% mark.
Okay, Brenda Kelly talking to us from London. Thank you. Really appreciate your thoughts there. All right, time for corporate news then. Let's go for it. So the decline of the Russian car market is accelerating, enduring a fall of 8% in October compared with a year ago. In September, the drop was 5%. Donald Trump is searching for a Russian partner to build a Moscow replica of his 58-story Trump Tower in New York. This will be the third time that the American billionaire will enter the Russian market. And a disaster week for Russian steel giant Metchel. The central bank has ruled that nearly $2 billion worth of ruble bonds issued by Metchel are effectively worthless. This follows the company's 40% drop in value on the stock market. Now, talking to metals, someone who had a personal experience with the metals market is Mr. Sean Thomas. It was a nightmare for you, wasn't it, Sean?
Not just a nightmare, a meltdown, if you will. See what
clever guy.
Right, right. But I'm glad to say that I'm out of it because, man, they really did take a beating this week, didn't they?
Absolutely. But what about your portfolio now? Because we've got a bit of Gazprom, we've got a bit of Bitcoin. How did you get on?
Well, the bad news is Gazprom was down 1%, so I lost $77 with Gazprom. But some funky news, it's a bit coin, right? You know, some funk there because Bitcoin up 25%. It's up 24% against the US dollar. When I first made the decision, I walked out of the studio and I was devastated because I heard that Bitcoin crashed. In fact, we even got some comments about that. But it rallied through the week. I made $500 total, even though Gazprom was down, meaning my grand total is $9,819. So I'm about as happy as you can possibly be.
You're nearly there, Sean. You're going to stick with Bitcoin then, I'm going to presume.
Indeed, because if I get above that 10,000, I'm going to buy you that budget ticket airline down to Sochi or wherever you choose to go. But you know what? I'm going to see if I can see if I can make some money and finally do this thing right.
Okay. Do I get food on the plane?
Of course, indeed. We'll have to bring it from McDonald's or something, but we'll make it happen.
Perfect. I like a burger. All right, Mr. Sean Thomas, well done. Congratulations. But let's get you over that threshold next week with a bit of Bitcoin then. And this week, the most expensive diamond in history was sold to a mystery buyer. The pink star, as it's called, is the size of a golf ball and was snapped up for $83.2 million, smashing the previous record of $46 million, which was for another pink sparkler. And in third position is a bright orange rock. It was sold for $36 million. But I do like the pink ones, I must say. Now, it's not just diamonds that are breaking records, but it's paintings too. Now, this Francis Bacon masterpiece, The Three Studies of Lucian Freud, has just been sold for a record $142 million. Now, these record prices are not necessarily because diamonds and paintings are more expensive now or more sought after. It's also because the value of money is decreasing, which is the same reason why there are now a record number of billionaires in the world. So, if we were to counter in inflation to all of this, it would actually be 6 paintings that would fetch more at an auction today. So featured in that, you've got Van Gogh, Klimt, Picasso, de Kooning, Pollock, you know, all the great masterpieces, as you can imagine. Now, this Cézanne masterpiece would be the most expensive of all. It was purchased in 2011 for $140 million. There we go. Which today would equate to, if we counter in inflation, $162 million. Ta-da! A little bit out of my price range just there, but there we are. That's venture capital for today. And I mentioned earlier on the Ukraine and EU trade deal. That's what we're focusing on next week, of course, and we'll have lots more, of course. Thanks ever so much for joining me. I really appreciate it.